So you want to own a hedge fund. Billions of dollars flowing into your account. The smartest investors in the world calling you for advice. Your name on a gleaming office in Manhattan or London or Hong Kong. You've cracked the code. You've found an edge. You've built a machine that prints money while you sleep. That's the fantasy. Here's what actually happens. Owning a hedge fund looks like one of the most profitable businesses on earth. It is, but almost no one who owns a hedge fund makes significant money from the hedge fund itself, and the few who do have usually spent a decade losing money on the way there. Before I break down the brutal math, I want to ask you something. Where in the world are you watching from, and what business are you in? Drop it in the comments. Because if you're someone who thinks about money differently, who looks at the financial system and immediately starts asking how the economics actually work, you're going to find people down there thinking the exact same thing. That connection might be worth more than anything else in this video. Let's start with the promise. A hedge fund is a pooled investment vehicle. You take money from wealthy individuals, pension funds, and institutions. You charge them a management fee, typically 2% of assets under management per year. You charge them a performance fee, typically 20% of profits. You invest that money. You beat the market. Everyone gets rich. The math sounds incredible. Let's say you have $100 million under management. 2% of $100 million is $2 million per year just for existing. You make a 20% return. That's $20 million in profit. 20% of that profit is $4 million in performance fees. You've made $6 million in a single year without risking a dime of your own money. Scale that to $1 billion under management, $60 million per year. Scale it to $10 billion, and you're talking about $600 million annually. This is why hedge fund managers are among the highest paid people on earth. But here's where the story breaks. Getting to that $100 million under management takes longer than you think. It takes longer than almost every hedge fund manager thinks. The average time from launching a hedge fund to reaching $100 million in assets is 7 to 10 years, and during those 7 to 10 years, you are losing money. In the first year of a hedge fund's life, the average fund has somewhere between $5 and $30 million under management. Let's say you land at $20 million. 2% of $20 million is $400,000. That covers part of your salary. It covers maybe one analyst. But you need infrastructure. You need a prime broker who will lend you securities and execute your trades. Prime brokers charge fees. You need a back office. You need legal and compliance. You need to rent office space in a location where you can attract talent. The cost of running a hedge fund, even a small one, is between $1 and $2 million per year in fixed costs. You have $400,000 in revenue. You are losing $600,000 to $1.6 million per year. You have personal capital. You've put in your own money to get started. You live off that while you build the fund. You work 80-hour weeks. You miss family dinners. You watch other people your age move into senior positions at larger funds or exit to start their own ventures, many of which fail. After 3 years, you've reached $50 million under management. Now you have $1 million per year in management fees. Your operating costs have risen to $2 million because you've hired a portfolio manager, added compliance staff, upgraded your technology, and moved to a better office. You are still losing $400,000 per year, and you are now running on fumes. You've depleted your personal capital, you've borrowed money from friends, you've maxed out your credit cards. Many hedge funds die here. The founder runs out of money. The fund closes, the investors get their money back, the dream ends. The ones that survive hit a critical threshold. Around $100 million in assets under management, the economics start to work. $2 million in management fees, $2 million in operating costs, you break even. Add in even modest performance fees and you're profitable. Now you can pay yourself a salary that isn't destroying you. Now you can breathe. But you've just spent 5 to 7 years making zero money. This is why almost every successful hedge fund manager is independently wealthy before they start. They come from families with money. They worked at Goldman Sachs or McKinsey for a decade and saved aggressively. They inherited enough to survive the startup phase. The hedge fund industry looks like a meritocracy. It is actually a capital-intensive business that requires either existing wealth or access to existing wealth to get started. Once a fund reaches scale, the economics are genuinely attractive. A $500 million fund with $10 million in management fees and modest performance fees can generate $50 to $100 million in annual profits. But scaling from $100 million to $500 million is itself another 5 to 10-year journey, and it requires different skills than launching. You need sales ability, you need a track record, you need to be able to attract institutional capital. Many founders cannot do this. They can start and run a fund, they cannot grow it beyond a certain size.
Here's the darker math that nobody talks about. Most hedge funds underperform the S&P 500. 70 to 90% of hedge funds, depending on the year, underperform a simple index fund. Yet the management fees continue. 2% per year, whether you beat the market or lose to it. Over a decade, that means the average hedge fund investor would have been better off putting their money in an index fund that charges 0.03%. The economics of a hedge fund are great for the manager. They are brutal for the investor. A hedge fund makes money on management fees regardless of performance. This creates a perverse incentive. Once a fund reaches scale and profitability, why work harder to beat the market? Why take the risk of looking bad in a down year? Why not just collect 2% per year, manage the fund competently enough to keep investors happy, and gradually get richer while doing less work? Some of the most successful hedge fund managers in history have essentially done this. They build a fund to a scale where the economics work. Then they coast. They make changes slowly. They become risk-averse. They use their success as currency to attract more capital, which generates more management fees, but they don't actually try to beat the market anymore. David Swensen, Yale's legendary endowment manager, famously said that the hedge fund industry exists primarily to enrich hedge fund managers, not to generate returns for investors. He was right. So why does anyone own a hedge fund? Why do people spend 10 years losing money to build something that finally becomes profitable? The answer is the same as almost every other business: leverage and scale. Once a hedge fund reaches a certain size, the founder can sell a stake in the fund's management company itself. They don't sell the fund, they sell the company that runs the fund, the part that collects the management fees. An investor buys a 25% stake in a management company. That company generates $50 million per year in management fees. 25% of $50 million is $12.5 million per year forever, in perpetuity. A buyer might pay $800 million for that 25% stake. The founders started with nothing. 10 years later, they own 75% of a management company worth $3.2 billion. They've been worth $3 billion for years, but only now can they actually realize some of it by selling equity. This is why hedge fund managers stay in the game despite the brutal early years. This is why they grind through the losing phase. This is why they build at scale, even when scale doesn't help returns, because the leverage is in the management company, not the fund itself. The fund is just the vehicle. The real business is collecting fees. So the next time you see a hedge fund manager on television talking about their brilliant investment thesis, remember what you're actually watching. You're watching someone defend the primary source of their wealth, which is not investment skill. It is the 2% management fee applied to billions of dollars. The fund can underperform the market for years. The manager still gets richer. The investors still get poorer. And not is the economics of owning a hedge fund. You don't actually make money owning the fund. You make money owning the company that collects fees from the fund. And getting to that point requires surviving a decade of losses, which requires wealth you don't yet have, which is why almost nobody ever does. Drop a comment telling us your city and what time it is for you right now. And if you found this as infuriating as I did, hit subscribe. Next time, we're breaking down an industry that's even more rigged.